The silver market is often discussed as if it were a single, unified system. A price is quoted, charts are analyzed, and conclusions are drawn as though that price reflects the state of silver everywhere, in every form. In reality, silver exists in two parallel markets that behave very differently under stress. One is visible, liquid, and heavily traded. The other is quiet, constrained, and governed by physical limits. The gap between them widens not during calm periods, but when pressure builds. Paper silver is designed for efficiency. Futures contracts, options, unallocated accounts, and exchange-traded products allow large volumes of exposure to be created, adjusted, and closed with minimal friction. This system excels at price discovery during stable conditions. It assumes that most participants will never require delivery, that contracts can be rolled forward, netted out, or settled in cash. For long stretches of time, that assumption holds and the market appears orderly. Physical silver operates under a different logic. It must be mined, refined, transported, stored, and insured. It cannot be created on demand to meet sudden interest. Its availability depends on production timelines, inventory levels, and willingness to part with existing stock. These constraints are invisible when demand is routine. They become relevant only when behavior changes. The divergence between paper stress and physical reality does not announce itself loudly. It does not require a formal failure or a dramatic event. It begins subtly through preferences. Participants choose exposure over possession during calm periods. Under stress, that preference can reverse. Even a small shift in settlement behavior can have outsized effects in a market built on leverage. Paper markets are flexible by design. When volatility rises, margins can be increased, positions reduced, and exposure managed financially. Stress is absorbed through price adjustments and balance sheet movements. Physical markets are less forgiving. When demand rises faster than supply can respond, price is not the only variable. Availability, timing, and trust begin to matter. This is why paper silver can appear calm even as physical conditions tighten. Futures may trade smoothly. Volumes may remain high. Yet beneath that surface, inventories may be drawn down, lease rates may rise, and delivery timelines may stretch. These signals do not always translate immediately into higher prices, but they reflect a change in how the market is functioning. Importantly, this divergence does not imply imminent failure. Systems can operate under tension for extended periods. Paper markets are adept at managing stress through abstraction. Physical markets, however, reveal stress through friction. The two do not move in lockstep, and expecting them to do so leads to misunderstanding. Understanding this difference is essential for interpreting silver during periods of uncertainty. Price alone does not tell the full story. Behavior does. Who is comfortable with paper exposure and who prefers physical control? Who rolls contracts forward and who requests delivery? These choices shape the market long before any headline event. If your interest in silver goes beyond price movement and into how markets behave under strain, this distinction matters. Consider subscribing if this approach focused on structure rather than alarm aligns with how you prefer to follow markets. The key point is not that paper silver is unreliable or that physical silver is scarce by default. The key point is that they respond to stress differently. And when conditions tighten, those differences become informative. To understand how and when this divergence tends to widen, We need to look more closely at what paper-silver stress actually looks like and why it often precedes rather than coincides with changes in the physical market. Paper-silver stress rarely looks dramatic. It does not arrive as a headline or a declaration. It appears instead as a series of adjustments that seem routine in isolation but meaningful in combination. Margin requirements change. Volatility assumptions are revised. Financing costs edge higher. None of these signals imply failure. They indicate that the system is working harder to maintain equilibrium. Paper markets are designed to absorb stress through repricing rather than interruption. When demand increases or risk rises, the first response is financial. Prices move, spreads widen, and leverage is reduced. Participants adapt by reallocating capital rather than changing the form of exposure. This flexibility is a feature, not a flaw. It allows large volumes of silver exposure to exist without requiring large quantities of metal to change hands. Stress in this environment is measured by sensitivity. How quickly does price respond to relatively small flows? How rapidly do margins rise during volatility? How cautious do counterparties become? These are not signs of collapse. They are signs that tolerance is narrowing. One of the most important characteristics of paper-silver stress is that it can remain contained within the financial layer for long periods. Contracts can be rolled forward. Losses can be realized and offset. Exposure can be reduced without ever touching the physical market. From the outside, this looks like stability. In practice, it is a form of internal compression. As stress increases, paper markets become more efficient at rationing risk. Participants who cannot meet higher margin requirements exit. Volatility is priced more aggressively. This process can suppress price even as underlying tension grows. The result is a misleading calm, where visible metrics suggest order while capacity is quietly shrinking. This is why paper stress often precedes changes in physical behavior rather than coinciding with them. Financial participants adjust first because their tools allow them to do so. Physical participants adjust later because their constraints are different. A futures trader can reduce exposure in seconds. A manufacturer or refiner cannot adjust supply chains with the same speed. Another factor is substitution. In paper markets, stress encourages substitution into related instruments. Exposure can be shifted between contracts, maturities, or products. This keeps the system liquid even as individual segments tighten. Physical markets have no such flexibility. A bar of silver cannot be substituted for a contract that promises one in the future. Over time, sustained paper stress changes incentives. Leasing becomes less attractive. Willingness to provide metal against paper claims declines. Inventory holders become more selective. None of this requires alarm. It requires only a reassessment of risk under tighter conditions. The important point is that paper-silver stress is adaptive. It redistributes pressure without resolving it. As long as participants are comfortable remaining within the financial layer, the system can function smoothly. The divergence emerges when preferences begin to shift, even marginally, toward physical settlement. To see how that shift takes shape, we need to examine the physical side of the market where stress does not compress quietly, but expresses itself through limits. Physical silver does not experience stress the way paper markets do. It cannot compress pressure through abstraction or substitution. When demand changes, it must be met with metal that already exists, metal that can be located, moved, and delivered. This difference is why physical reality often lags paper stress and why, when it responds, it does so unevenly. In the physical market, stress shows up first as hesitation rather than disruption. Inventory holders become less willing to sell forward. Lease terms change subtly. Delivery timelines stretch without explanation. Premiums widen not because of panic, but because optionality has value. These are not failures. They are rational responses to uncertainty. Unlike paper markets, where exposure can be adjusted instantly, physical silver requires commitment. Once metal is sold and delivered, it is gone. Replacing it takes time. This makes physical participants more sensitive to regime changes. They do not react to price alone, they react to persistence. A higher price for a day is noise. A higher price that holds begins to alter behavior. This is where divergence becomes visible. Paper silver may absorb stress through price volatility and margin adjustments, while physical availability tightens quietly in the background. Futures curves may remain orderly even as fewer bars are offered for immediate delivery. The two markets appear connected, but they are responding to different incentives. Industrial users are often the first to notice this shift. Their concern is not speculation, but continuity. When availability becomes less certain, securing supply takes priority over optimizing price. This can lock up metal that would otherwise circulate, further reducing flexibility. The impact is gradual, but cumulative. At the same time, physical silver is geographically fragmented. Supply chains span jurisdictions, refineries, and vaulting systems. Stress in one segment does not immediately transmit to others, but it alters routing decisions. Metal moves toward where it is most valued or most secure. These flows rarely make headlines, but they matter. The critical point is that physical stress does not need to be dramatic to be consequential. It only needs to change behavior. When fewer participants are willing to part with metal under uncertain conditions, the market's capacity shrinks. Price alone does not solve this. It reallocates, but it does not create supply. This is why physical reality often asserts itself late in the process. It waits until paper adjustments are no longer sufficient to balance incentives. When that happens, the divergence that once seemed abstract becomes tangible. Understanding this sequence matters. It explains why calm paper markets can coexist with tightening physical conditions, and why conclusions drawn from price alone can be misleading. The physical market speaks softly, but when it does, it speaks through constraint. To understand how these two layers eventually reconnect and what forces that reconciliation, we need to examine how preference shifts, even small ones, change the balance between paper claims and physical control. The point at which paper stress and physical reality begin to reconnect is not marked by a declaration or a rule change. It is marked by preference. Markets are governed less by what is possible than by what participants choose to tolerate. As long as paper exposure is preferred to physical control, divergence can persist. When that preference shifts, even slightly, the structure begins to rebalance. This shift does not require fear. It requires uncertainty. When participants become less confident that paper claims will behave as expected under all conditions, they begin to value optionality differently. Optionality, in this context, means the ability to choose settlement form rather than accept it by default. Physical silver represents that option in its most literal sense. What makes this phase difficult to interpret is that it unfolds quietly. There is no singular trigger. A refiner may decide to hold inventory longer. A vault operator may become more selective about leasing. An industrial buyer may increase buffer stock modestly. Each decision is rational on its own. Together, they change the flow of metal. As these preferences shift, paper markets continue to function, but with subtle changes. Open interest may decline even as volume remains high. Forward curves may flatten or invert briefly. Lease rates may move without explanation. None of these signals imply breakdown. They imply that the cost of convenience is rising. This is where misunderstanding often arises. Observers look for dramatic confirmation and find none. Prices may remain contained, contracts continue to settle. The absence of visible disruption is taken as evidence that concerns are overstated. In reality, the system is adapting to new constraints. Physical reality asserts itself not through collapse, but through friction. Transactions take longer. Negotiations become more detailed. Counterparties ask different questions. These are not failures of trust. They are recalibrations of it. Trust becomes conditional rather than assumed. The reconciliation between paper and physical markets does not require all participants to demand delivery. It requires only that enough participants consider it. When that threshold is crossed, behavior changes upstream. Paper exposure is still used, but it is used differently. Hedging becomes more conservative. Duration is shortened. Leverage is reduced. This is the phase where price can become misleading. A stable or even declining price does not necessarily indicate easing conditions. It may indicate that pressure is being absorbed through reduced activity rather than increased supply. The absence of price movement can reflect restraint, not relief. Over time, this restraint reshapes the market. The paper layer becomes thinner, not because it disappears, but because it is used more selectively. The physical layer becomes more influential, not because of scarcity headlines, but because of behavior. The two layers begin to inform each other again. This reconnection is rarely symmetrical. Paper markets adjust faster. Physical markets adjust slower, but with more permanence. Once physical behavior changes, it does not revert quickly. Inventory decisions, supply chain adjustments, and custody preferences persist beyond the immediate cause. The important insight is that divergence is not a failure state. It is a transitional one. Paper and physical silver diverge because they are optimized for different conditions. They reconnect when conditions force alignment. That alignment is not dramatic, it is consequential. Understanding this process requires patience. It requires watching how participants behave when incentives change, not when narratives do. It requires attention to what becomes harder, not what becomes louder. This is why discussions that frame divergence as imminent crisis miss the point. The real signal is not whether the system breaks, but whether it adapts smoothly or with friction. Silver's structure allows it to signal that difference earlier than most assets. To see how this adaptation phase typically resolves and what it implies for silver's role going forward, we need to step back and examine what happens after. Divergence has been acknowledged, even quietly, by the market itself. The final stage of divergence is not resolution. It is acceptance. By the time paper-silver stress and physical reality have both adjusted to new constraints, the market no longer behaves as it did before the divergence appeared. Even if prices stabilize, something fundamental has changed. Participants now understand that the two layers are not interchangeable under all conditions. This is where many observers misread the outcome. They expect a moment of validation, a spike, a shortage headline, or a visible break. Instead, what emerges is a quieter shift in norms. Contracts are structured more cautiously. Inventory is treated as strategic rather than excess. Exposure is sized with an awareness of physical limits rather than abstract liquidity. Paper markets continue to exist because they are useful. They provide flexibility, hedging efficiency, and scale, but they are used with greater restraint. The assumption that exposure can always be rolled forward without consequence weakens. Settlement optionality becomes part of the calculus, not an afterthought. Physical silver, meanwhile, does not become scarce in an absolute sense. It becomes selective. Availability depends more on price persistence, counterparty trust, and timing. Those who require immediacy or certainty pay for it, not through panic premiums, but through reduced choice. The market becomes less forgiving, even if it remains functional. This is the lasting impact of divergence. It changes behavior long after the initial stress fades. Participants who experienced friction remember it. Risk managers incorporate it. Supply chains adjust around it. The system does not reset to its previous assumptions. What silver ultimately reveals in this process is not fragility, but limits. Paper markets are excellent at managing volatility. Physical markets define capacity. When the two diverge, it signals that capacity is becoming relevant again. This is why framing divergence as a binary outcome misses the point. There is no need for failure to occur for the signal to matter. The signal lies in adaptation. How much effort is required to maintain equilibrium? How much optionality is lost? How behavior changes without announcement? Silver is uniquely positioned to expose this dynamic because it lives in both worlds. It is financial enough to be abstracted and physical enough to resist it. That tension is not a weakness. It is information. Understanding the difference between paper-silver stress and physical reality is ultimately about understanding how markets behave under constraint. Not when they break, but when they adjust. Not when trust disappears, but when it becomes conditional. For those watching silver through this lens, the takeaway is simple. The most important signals are rarely loud. They are embedded in how participants change behavior before they change their language. If this framework has helped clarify how divergence forms and why it matters, share it with others who approach markets structurally rather than emotionally. And if you've observed similar behavior in other markets where paper exposure and physical reality begin to drift apart, add your perspective in the comments. Silver does not need a crisis to speak. It speaks through friction. And friction, when understood, often tells the truth earlier than price ever will.